All right. Good morning, everybody. It's interesting. We're getting PPI in front of CPI, and it doesn't always work that way. I think this could load us up for potentially an even bigger move into CPI. I say that with a little asterisk, though, right? We've all been there where we have this known unknown in the future. Everybody starts getting hyped up about it. We hear about, oh, it's going to be such a big move, and then nothing, right? The nothing usually comes because they hedge it to the eyeballs and then they don't care which way it goes. Think about why price moves so fast during an economic event. It's generally because everybody's scrambling to do the same thing at the same time. Everybody wants out, everybody wants in, and then that drives price really fast. Usually because they're on the wrong darn side, right? They're heavy long and they need to get out. They're heavy short, they need to get out. But when we have a known unknown, they know that something's coming, they can hedge it, and then they don't have to scramble, they don't have to get out. And so then we're all waiting for some big move and we don't get it because there is no scrambling, right? Kind of follow along with the process. When you do see the big moves on economic events, it's generally because there was some sort of surprise, and complacency is a big part of it. So when I see them saying things like, "Oh, we know what the numbers are going to be," or "Oh, we know the outcome," that's usually where we get those big moves. They're cocky, arrogant, they think they know it all, and then they get blindsided by the data and it knocks them for a loop. That's not this week, right? Everybody's worried. The big moves of the last 10 days has everybody shook. Hedges are high. The expectation that we can't have the expectation that they're going to be caught blindsided and cocky if they're all scared and nervous. So, as much as we anticipate CPI and PPI causing big moves, on the other side of that, I think they're hedged, and the big move is likely going to come because people want to monetize that data rather than because they're scared of the data, right? Does that make sense? You follow me on my roller coaster logic? It's my world, squirrel. Just trying to get a nut. So most of this data is all up in the front. By 8:30, we'll have the worst of it. But as you can see, later in the morning, we got Redbook, and then we have Bosick in the afternoon. It says speech, but as I've mentioned before, you want to know where they're speaking at. Don't take it at face value that they're going to be live, because they don't have to be. They can just be something that was pre-recorded and submitted. Two, if there's no Q&A, then the likelihood of a car crash in their answers is reduced significantly. The chances that they can be misunderstood or misinterpreted, or that they can just straight up say something they shouldn't have said, goes down radically without the Q&A. So, you always want to know what it is that they're doing, where they're speaking at. This is at the African American Financial Professionals in Atlanta. It's a moderated conversation, so there should be some give and take, some Q&A, and that sets us up for errors and misquotes, for the algos to take things into their hands and shake the market a little bit. We have a lot of markets setting up with this pattern. The Mag 7 group. I'll just use AI from Amazon here for a moment. If we are using OCR style analysis, that's one candle reversal OCR. You look at these lows here. All of these are a higher low, right? Higher low, higher low, higher low, higher low. Until it isn't, right? And the first lower low may not be an issue. I would call that the trigger alert. The second lower low is the short, the trigger short. Now, I'd much rather, take a short off the highs than take a short from the hole. That's just the nature of the way I trade, right? But if you didn't get a chance to catch it along that 168 across the highs there, then you got to take the low side. But you'd want to join a trade in its move, whether you're buying a breakout or selling a breakdown in a momentum play, because there's no pullback in a momentum play, right? Momentum just goes and you hop on the train or get left behind. If you sit around waiting for a pullback so that you can buy low, sell high, or sell high, buy low, you wait for that kind of trend trading behavior in a momentum trading environment, you're going to get left behind. So we do want to see some indications that there is momentum, that it's not just your basic trend play to the downside for that short. Target would be the bottom of the box, 160. The box is based on this green bar. Notice it's not a hollow green bar, right? It's a solid green bar. That shows that it closed lower than it opened, but it closed higher than the previous day's close, right? That's the way these candles work. They're smart enough to show us how they closed in relation to the previous day. But that bar's highest and lowest point is what we've been stuck inside. And if you want to tighten that up even more, we've got this bar right here, and we're inside of that. IX10 is inside bar at least 2 days, right? So if it's just a 1 day, then it's just inside day. You get multiple inside days, and it's IX10. When it's a really wide IX10, it's not really all that enticing because it's a really wide bar. Not hard to imagine that we're staying inside of it. When the range really tightens up and then we stay inside of that single bar, well, then you got my attention because there's a lot more compression to it. This is just one name. It's just Amazon. Apple continued to just climb, right? All the way up to get the gap closed. And now here we are stuck inside of yesterday's range. So no IX10 on Apple because it just continued to advance. But check out Google. Same situation, only this one didn't climb up, right? It just popped back and it's been stuck there right across the top. Now this is a really wide bar, so IX10 isn't really exciting on this one, but yesterday's range would give us the trigger alert, and then say 50% of this range would be the trigger short if you couldn't get the short off the high, right? We can circle back to that again and again. Meta, same thing. Inside range, inside of this day. This one's not overly exciting either. Apple and Meta both, if we're looking for compression, then neither one of those two really fit the bill. Microsoft inside of this really big bar way back here. So that's not exciting, right? And every one of these from an OCR perspective, higher highs, higher lows, and we still have that, right? So that would need to change. Compression not really showing on that one. Netflix, it's back up to the 50-day moving average too, so it has that to fight against. But higher highs, higher lows, not really what we're looking for. NVIDIA, it tried to break out this morning. That failed so far. And even if we do get the breakout, we got the 50 there. The range was wide. It extended for multiple days, and it was wide from its high to the low point. So we were stuck inside that range, but it wasn't really exciting until it started to tighten up. Tesla, on the other hand, that's a really tight range, and it got tighter. It was way back here, this range from the 7th, and then we tightened it up even more. So this one looks good, but I would give it a little room if I'm going to short it. I would either catch it across the high, which we no longer have that chance to do unless it runs back up there, or we got to catch it on the breakdown because these buyers keep stepping in, and they stepped in on the 9th and the 12th a lot faster than they did on the 8th, right? So they're picking it up for whatever reason. So I want to see that they're gone before I try that one. But I like Amazon the most out of these. A lot of these that I just went through had the higher low setup, right? That's one thing to really focus on, is that higher low setup. Because if it gives like a domino, I think we'll see it ripple across on all of them. Notice we had the ES, the NASDAQ, the 10-year, the dollar all fall, right? There's everything's just synchronized in that. That makes it really frustrating if we're trying to use things like a swag level, say the 10-year above or below 3.9, the dollar above or below 103. Those aren't going to be as useful or as impactful to us on the day trades when we've got all four of those doing the same thing all at once. Now, the 10-year and the dollar are still falling. The NASDAQ and the S&P turned around and caught a bounce on the 10-day moving average or the 3-day moving average, take your pick. They flipped and went back the other direction. So they're not in sync at the moment, but they all fell all at once. This morning, we're really no closer to the upper edge than we were to the lower edge. I mean, just a little bit, 0.25%. That's not much. If you looked at the spot gamma data this morning, their levels didn't change. So the Thinkorswim levels that we could get from them when I downloaded it, it was the same data as yesterday. They didn't change it. When they've done that before, I thought, well, there was something wrong, right? Maybe I screwed up the file, grabbed the wrong one, something like that. But nope. If they don't change it, they just leave the same text document in there. They don't bother to update the date, and it's just the same document. So if you're wondering where's the spot gamma levels on Thinkorswim for today, just use the one from yesterday because it's the same one. They didn't change anything. So we're hovering around VWAP. It's like reciprocation. What we get on top, we're getting on the bottom. We're waiting on data. I still say we're waiting on CPI, but that doesn't mean we can't move today on PPI. And I think the data that we get today from PPI is going to more greatly exaggerate the move that we could get on CPI tomorrow. I was talking this morning with somebody about volatility, and I know I get it. It can be really confusing. There's so many different ways to talk about volatility, to discuss price moves in the market. I got these labels across the top of my screen, and you've got ATR, ADR, standard deviation levels from price, standard deviation levels from the options implied volatility. There's so many ways that we can define volatility. Volatility is another word for movement, right? So if you look at big candles in relation to where you normally have little candles, then you would say we have volatility. So like every day when the market opens and we get these really big candles at the open, that's a perfect example of volatility. If you look at the volatility indicators, something like VIX, it may not register. If you look at the options and try to gauge, are these options swollen with a greater cost of implied volatility than normal, it may be harder to see there. But in a simple context of, does this particular market have volatility? One thing you can always do is just look at the candles themselves and let that be your defining characteristic of volatility. It's harder to quantify, right? Because we all usually like having an actual number there that we can say the volatility is X number, right? But is there volatility if the current bar is 2 or 3 times the size of the average bars around it? Then you've got volatility, right? It's a nice way of just quantifying what volatility is. I think I moved too fast. I gotta give Thinkorswim a moment to catch up. Broke it. We'll let it settle for a moment. Look at the overnight volume, came in at 71. It's certainly better than yesterday, likely because of the sell-off that we had, this little V bottom that we got on the bounce. It brought in some liquidity, but it's still light trading out there. So you have to keep that in mind, especially if you're not just trading the futures, you're trading, stocks and options. Options volumes are really low right now. It's hard to find anything that has, some good liquidity to it from a day trading perspective. It's not to say that there isn't any trading going on, but it's really concentrated into just a few names. And so when we look around at anything other than, say, the Mag 7, there's just not a lot of liquidity out there. That makes it difficult for newer traders to define, is this liquid enough to trade? Right? Typically we tell people you want to see thousands of contracts in the open interest and thousands of contracts being traded per strike on most of the strikes that are near the money, and it needs to have weekly options and a tight bid ask. Well, most of those conditions aren't being met right now, even in names that we would expect to have even, remotely decent liquidity, just aren't. It was way worse during COVID, I tell you, but it just comes and goes in waves, and you have to take the good times with the bad times. So same levels as yesterday. I've already defined the halfback, which we found it this morning, 53.72. It's also where the 10-day moving average is, and it's the volatility trigger. Kind of want to stay above that level. We're still in zero gamma, by the way, although that is arguable depending on who you're listening to. I just listen to spot gamma. Keep your data from the same sources so you don't get muddy data. And according to them, we're still in zero gamma, negative gamma. With that statement on the table, it still means that exaggerated moves to the downside will be sold by the institutions, right? They will sell, well, by the market makers. They'll sell to get back to delta neutral. This doesn't account for things like the CTAs or the VC funds and their triggers to continue buying or selling go beyond this scope, right? So on the SPX, for an example, the CTA positions, there was a little bit of a bounce in there. But it's already begun to sell off. The green is their positions. The white is the SPX. Well, either this needs to catch up or that needs to catch down. And we can see their positions were close to the zero, right? They got really close down there. Look at the last time they were that deep, October 2023, right before the November flip in QRA. We want to have some actual data with it. Where were they at a month ago? 2.8%. Where were they yesterday? 1.4%. Where are they at today? 0.9. They are diminishing their position. All right, the call out Monday was that we would stay range bound into Wednesday's data. That's still my base case argument. We could expand like we did yesterday outside of Friday's range, and it was still sold off. Or as we did this morning, we expanded outside of yesterday's range, and again, we sold off. We have the liquidity zone or the sell zone within the 111 and the 100 area. Of course, that doesn't improve my my spelling any. It'll work. Sell zone. If we go to the bottom side, you can do the same thing in the other direction. So just use the same tools, same metric, same application. We're not expected to leave that range until we get the data, right? So we can wick out of that range, certainly, but we're not expecting to close outside of it and expand beyond it until tomorrow's data. So if we do, say, get past the 1, 2, 3, 6 on either side and continue to drive, then we'll say that this thesis is no longer in play, that it's no longer valid, and we would want to use the expansion thesis instead. There's nothing wrong with having a plan and then having a backup plan, because you know, it's kind of binary. If A, then B, right? The channel is even more narrow today than it was yesterday. A more narrow channel implies that if we break out, it likely sticks. But that goes against the data, and it goes against the idea that we're going to wait for the data before we break out. The spot gamma index is still in the negative. It's at 1.8 to the downside. It only goes to -4. So, if we round down and say we're at a -2, then we're halfway to the most negative that we could be in the spot gamma index. The more negative it is, the more likely it is that breakouts continue to unfold and we continue to run, right? So that's a channel that says if we break out, we run. And then it's a spot gamma indicator saying if we break out, we run. Both of those are going contrary to me saying if we break out, we're very likely going to turn around and come back in again because we're waiting on data. Distance from the weekly floor pivot is not much greater than the distance was yesterday. It's worth noting that we started the week already above that weekly floor pivot, and I think we could expand a little more than this. This doesn't seem extreme to me at this point. We've certainly been farther away on a weekly basis than this. So it might seem like a lot, but if we, expand the chart here a little bit, just last week, for an example, we got much farther away from the weekly pivot than we are now. That was a downside example. So, we could certainly look at some distance from the floor pivot to the upside as a good distance, where we really just capped out and couldn't get farther away. This one's even greater. So on how far away we are from the weekly pivot, I've tried to, run systems and calculate this in a way that we could find a common number. But so far, it's that hasn't been very fruitful. So I just look at it. I look at it and try to gauge it in relevance to the current moves, how big the candles are, the price action when we did get max distance away, like this morning we set our new max distance. How did price respond at that level? Were we able to get back to that level again, test it? What did the liquidity look like on the dome? All of those kind of questions, trying to answer, are we too far from that floor pivot yet? And at this point, I'd say, no, this isn't as far as we could get. I would expect more. We don't have an MDP because we hit it yesterday. We're not going to have one tomorrow because we've already hit it today. There's a lot of concern that this rally back up in the S&P, or in the indexes really, is more of a dead cat bounce than a true rally back up, especially when you look at it on a weekly. That really looks like a threat for a dead cat bounce. Now, we won't know for sure unless or until it rolls over and continues to move to the downside. But I pointed out last week, and I'll continue to point it out, that this is the level that we have to get above, right? Because we need to set this this pivot back in the other direction, and it needs to be a high pivot. On the daily, that would be our lower high that we have to deal with. On the weekly, there is no other one, right? It's all the way up here. The problem is the halfback. 50% of that red candle. That's going to be a difficult level to get through. It's also 54.50, so it's an options level. Right now, we can't seem to get above 5,400, another options level round number. That's the line in the sand right now that we're having a hard time getting through. Take yesterday's, last week's range. We tried an inside week breakout already and it failed. We're trying it again. We can mark out the sell zone here, just like we would on any other chart. We got to get through 54.11 cog line, or this 111 here. We got to get through all of that. And even if we do get through it, we got a 10 period moving average right there. Excuse me, 10 week. At 54.32 cog line. That's a significant level of resistance. It's going to be difficult to get through there with the straight shot. So just like when we were looking at Amazon and those others, we've got these higher lows. That'll work. These three higher highs and these three higher lows on an OCR style analysis. We start breaking into lower lows, then the market's very likely going to cascade and domino to the downside. So that's the concern, right? Not just in the Mag 7, but also here. 53.50 is near this low here, and below that would be 53.32 cog line. Then we get closer to 5311 cog line and 5300. The spot gamma had some levels that it laid out as points of no return, where they think if the SPX gets below 5300, that we very likely expand fast to the downside. Well, look at the 5300. We're really close to it, right? We closed around just under 5350. So 50 points in the SPX, that's nothing, right? 50 points among friends. It's just a little something, something. So keep your eye on 5332 and then 5311, then 5300. That'll be the spot gamma level of concern. We get below that and it's game on. We don't have SPX ADR levels for today. We won't get them until the market opens because it doesn't have anything to read right now. So ignore these. They're not today's, they're yesterday's. We are expecting volatility, but I'm going to stick with my base case argument that we hold the line today and that we are waiting for CPI tomorrow. That means we should stay within the red bands of today. Even if we wick outside of them, the expectation is that we come back in. Yeah, volume is just really light. 10-day, 30-minute volume profile with TPO. The TPO is starting to show a more classic lowercase b. There's no expectation that this point of control is going to move anytime soon. We're back up to where it was where we were developing this structure. I've still got my highlighted candles back here. This is the area that I kept pointing out, saying if we get into it, it's very likely going to be difficult to get through, since all of that previous volume and that previous structure was there. And so far, it's continuing to prove me right. I think I'd rather have been wrong, though, right? There's just times where I wish I wasn't right. So when we look at it on this time frame, it was this level that I kept pointing out. We mostly stayed underneath it last week, kind of got into it a little bit on Wednesday and then on Friday. And we're still fighting that level now. It does look like if we get above 5,400, then we can challenge the next zone, which is above 5,450. But what's the catalyst to turn us so bullish as to do that? And I think the answer for me would be if we get CPI that pleases the market. Otherwise, if they throw a temper tantrum or in some other way reject the data that we get from PPI or CPI, then I think the negative continues. We're in this dichotomy where things are changing, right? Bad news is suddenly starting to actually be bad news. And for so long, bad was good and good was bad. So we track the point of control from the previous day only if it hasn't been touched. Now, different analysts interpret that different ways. If it's been, quote, hit by price at all in any way, shape, or form after that day is closed, then technically it's been touched. But if you want to be more lenient, I guess is a good word for it, then you could say price has to close on the other side of that level. We've hit this pivot point this morning. That's yesterday's point of control, but we didn't close below it, at least with any significance. So you could consider this as a point of control that is still there. And it's worth noting the textbooks would tell you to do it every day, right? They don't make the distinction on has it been hit or not. If you study volume profiles, they'll tell you to carry forward yesterday's high, value area, low value area, and the point of control into today's trading. I've already got enough pivots. I don't need that many more. And I really just want to keep track of the ones that have not been hit on this point of control. And actually, as I'm zooming it in here, yeah, okay, it's been hit, but we didn't get through it on the other side. That was actually right to the tick. So I'm going to put it on there and say that that we have a valid VPOC here. If you want to be more strict than me, you could say, no, we touched it. It's done. The reason we even mark these levels, it's where the greatest amount of trading took place in the previous day's session, right? It's not like we just want to draw a line at a particular spot like yesterday's high or yesterday's low, because the line itself doesn't inform us of anything. Why are we drawing the line there? Well, I want to know if we go back to the area where we had the greatest amount of trading yesterday. It's very likely that there's some buyer's remorse or trader's remorse. I don't know if they bought. Think of it from your own position. If you got in yesterday at that point, and now here we are, 16, 18 hours later, we're back to that same spot. How are you going to feel about it? You probably would make an adjustment to your trade. That's why it's a level of interest to me. So I don't care that we tickled it or touched it. We didn't cross through it. So as far as I'm concerned, there's still a lot of potential liquidity there. And I would expect that liquidity to show itself if price gets back to that level. So I want it on the chart. And I'm going to leave it as a VPOC rather than just a regular POC, because as far as I'm concerned, it's still a virgin POC. That's what the V stands for. It's a virgin point of control. It hasn't been touched because I'm going to count it as only being touched if price closed on the other side. Simple enough. You can do it however you want. You just be consistent with it. One of the hardest things about technical analysis is that aspect right there. Stay consistent in your application and in your analysis of. So we're still within the week's expected range, which isn't a surprise because we're still inside yesterday's range. And yesterday was still inside Friday's range. We still haven't started the pull away from the 10-week yet. We're still seeing these higher lows on our distance away from the 10-week, less than 1% at this point. We're not oversold. We're not overbought. We're actually getting close to the zero line. When it comes to the 10-day, we're above it. I got to say, when we were falling towards it earlier this morning, I watched it moving in real time. This is the daily 10-period moving average. And, normally you don't see a daily moving average move. But as price was making this fast move to the downside, I was watching this 10 move farther away in real time. It's just a little quirk, I guess. I found it interesting to watch. That's how fast price was moving this morning. So the 10 does move, even though it's on the daily. And we say that it's a daily, so it doesn't count until the daily bar closes so that the 10 can be updated. Yes, but it is moving in real time. It's just a quirk, right? It's just the way it is. So we're back above the 10, but we're still really close to the 10. If we were looking for, something more than that, it would be back to our average at around 1.5%. We're nowhere near that. we can get above it and come right back down again, like we saw back here on July 31st. So, just kind of keep in mind, sure, we're back above the 10, but that doesn't take away from the argument that this could be a dead cat bounce. And if it is, then we're going to, we bounced on support, rallied up into resistance. That would be the flipping point. And then we would continue our leg to the downside and break the previous low with a new low. I still like this moving average target down here. It's the 400 period. It's 5,000 in price. Or 49.58. Close enough. What's 50 points, right? Really, we don't have much down. A 0.5% is our benchmark, and energy is down that 0.5%. We got nat gas, the mag 7, tech, semis. Now, I like that idea that semiconductors are up, but they're up, but they're having a issue with getting outside of yesterday's high. So we're back above the year-to-date anchored VWAP. We got the gap closed, but we're IX10 and we're stuck inside these 3 bars here. And TrendSpider showed this gap closed, but that gap's not closed. 231, nice round number. We closed at 227, and here we are in the pre-market at 228 plus, right? 228 and a quarter. Still inside yesterday's range. We got to get this 229 and a half. And then, of course, we got that sell zone up there. Liquidity resides on the other side of the pivot, right? Just keep telling yourself that until it sticks in. Buy the hat, get the t-shirt. This was Friday's range. Monday broke above that range. And what happened? We got into the sell zone. Weren't able to get through it. Sold back off again. So now we repeat the process, put all of that on yesterday's range. There's your sell zone. It's got to get through that zone. If we lose semis, we'll very likely lose any upside momentum in the market. We won't be able to sustain it and carry it through. We've got tech up this morning, which makes sense because we have semis up. It's trying for an inside day breakout. It's got to get it, right? Even if it does, we got this really big bar here from August 1st. Mark the half back of that. That'll be your significant resistance. It's 214.84. And that's if we can even get the breakout, right? And if you want to do it another way, then you could just measure this range that it was fighting and plot your 111 and your 1236. Now, make no mistake about it, we could be outside that 111 zone between 1 and 111. At the moment, we're just wicking up there until this candle has closed. Then we didn't close above the 111. We're just at the moment driving above it temporarily. We still got to see how this bar closes. NASDAQ still has that gap to close. This is the Qs, and the spot gamma levels are accurate. So we're above the volatility trigger, but we're still under 0 gamma in the Qs. I would not apply that indicator to the NASDAQ futures because they're trash, right? They say it at spot gamma right there in their Q&A or the frequently asked questions. And, you know, they've said it many times, and it's not their fault. It's the options in the NASDAQ futures are trash. So, you know, if you try to measure what trash looks like, well, you end up with trash for an answer. But the QQQ, on the other hand, is a very liquid. It's not as liquid as SPY. Nothing is as liquid as SPY, but it is very liquid. And so the options data on the QQQ is perfectly relevant. So we have tech, semis, pot stocks, and nat gas. You don't want a rally on pot stocks and nat gas. We need semis, we need the Mag 7, we need that tech. And without it, if we're lucky, we just stay sideways, like I've been saying. If we're not so lucky, without the Mag 7, we just go ahead and start selling off. And we get into that air pocket and we get a flash crash. Cheers, right? Sounds great. Watch the clock. You got 10 minutes for PPI. And then later in the day, Bostic. Be careful, be safe. Watch the clock. I'll see y'all tomorrow.